Okay, folks, so if you're a stock market participant of any kind, you're a trader, an investor, a conscientious observer, well, you better watch this video because we have a lot of important data to cover. Today, we're going to be doing a deep dive into what is going on with this market, why the American consumer is likely to soon wave the red flag at the Fed, how big money is positioning in this, and what that means for you and your moolah. And then we're going to be talking about the trade ideas that are going to allow you, hopefully, to benefit from this. And of course, as always, make sure that you do your own research on all ideas presented here on the channel. If you're the one taking the risk, you got to be the one doing the ultimate frisk. And quick plug, we are officially starting a flash sale on ZipTrader Options membership. You will now get $200 off with coupon code FLASH200, and that expires in a few days. And by the way, this is a great time to start trading options. Some of our recent alerts include Tesla puts, which had an 89% increase alert price to highs, gold calls, which ran some 129% alert price to highs, NVDA short-term puts, which ran about 74% alert price to highs, and SQQQ calls, which ran about 91% alert price to highs. On top of those, we've been making numerous other strategic dip buy alerts because I believe that this downtrend will eventually get bought up, and I believe those will age really, really well. Anyways, if you'd like to join us for options membership, we'd love to have you. I'll put that link down below. Okay, let's get to work. So April has so far been one of the biggest drawdowns we've seen in broad markets in the last year plus, a bit more than 5% down at some points. Of course, it's small chickens compared to the original inflation interest rate hiking crisis we had in 2022. That was about a 27% drawdown and far bigger for tech names and much, 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 much farther down for some of the small cap tech players and the Cathie Wood archetype stocks. But nonetheless, right now we are selling off from a market top that extended about 9% above all-time highs from the easy money policy era levels. We've been breaking down back to that era's highs, and we've just got a few percent left to get there. And if we drop below that 4,796 market high set on January 3rd, 2022, well, we've broken a key support level. But that's the point where technically you're going to start seeing a lot of asset managers start really rethinking the market thesis and de-risking again. Right now, of course, folks, we know that asset managers are worried about inflation reigniting, which has started happening, and they're worried that the Fed will go from expected rate cuts to perhaps no cuts at all, and some are even saying hikes. But all of this misses the bigger issue at hand, and that is the American consumer, and really the middle 90 to 95% of the American consumers, which aren't very happy right now. And the fact of the matter is that there's a lot of gaslighting being done right now on said American consumer, and that gaslighting is confusing those who make allocation decisions and even confusing the Fed. You see, the thing is, and what you're going to see as we go towards the end of the year is that the Fed simply can't afford to hike rates more, and moreover, the Fed can't even afford to keep rates the same. They must cut, putting aside the insane borrowing cost interest that we have to pay on the governmental level. Well, the thing is that the American consumer is on their last leg. They're hopping around the economy right now, and the elites are saying that they must be really, really happy because they're hopping. But the reason they're hopping is because they only have one leg left. Let me explain. So the increase in inflation is down at least year over year. Unemployment is down, but consumer confidence hasn't recovered. Consumer confidence is still below where we were in the 2021 heights, and certainly below where we were in the 2017, 2018, 2019, and right before the COVID crisis height. And this data set is a couple months dated now, but the trend has stayed overall the same. And in fact, in some metrics gotten worse when you're talking about inflation, when you're talking about consumer confidence. In fact, when asked, how would you rate the condition of the national economy right now, the number has stayed about the same for months now. Now, here's the thing. When diving into why consumer confidence isn't great, the politicians, the media, the pundits, and really the economists like to lean on this idea that the average person just doesn't know how good they have it. It's very, very common for media outlets to run articles saying, quote, why do so many Americans think the economy is bad when the data says otherwise? It's very, very common for people that make tons of money to say, why do the people that have no money feel bad and feel even worse than they did years ago? An article from The Nation headlines this, quote, unemployment is low, inflation has fallen, real earnings are rising, GDP growth has held up so far. The economists are happy, but for some reason the voters are not. It must be their own ignorance and obtuseness. So says Paul Krugman, House economist of the New York Times. So back up a second. So you have millions of Americans on one end that are saying, hey, we're doing way worse than we were a few years ago, especially before COVID. And then on the other hand, you have these Nobel Prize Ivy League graduate saying, wait a second, you're stupid. You're doing better. Just look at the data. And if you don't believe in the data, it's just because you're a moron. They say, oh, you're running out of money? LOL, you're wrong. How do I know you're wrong? Well, because I went to Harvard. I went to Yale. So you're stupid and I'm smart and you should listen to me and let me make the decisions. Now, look, there's nothing wrong with going to a good school, but some of the guys that come out of these schools are complete morons. They think because they got one of these degrees that entitles them to completely wash over any opinions of the average everyday American. And the reason that I'm even talking about this is because sadly, this kind of elitism is what makes many of the decisions in this country and why there's so many dumb decisions being made every single day. When people complain and millions of people say that they're unhappy with the situation, well, the economists will just say, yeah, it's because you don't understand the data. You're better off than ever, so shut up and take our policy proposals. Policy proposals like more and more debt, more and more spending, higher and higher interest rates, and of course, by the way, sending unlimited amounts of money abroad. So anyways, the question then becomes, okay, well, let's listen to the facts here. How many Americans think that the economy is doing bad? Well, in the latest polling from Civics, 61% of respondents rate the national economy as fairly bad or very bad, with 39% choosing the latter description. If you look at Family Finances polls the health of the average American household, well, about 48%, almost half of Americans say their family finances have gotten worse, and 34% stayed about the same. Only about 17% believe they've gotten better. So when you're hearing all of this rhetoric about, wow, the economy has improved so much, well, almost half of Americans' finances, according to the Americans themselves, have gotten worse. And about 34% have stayed the same, and just a little bit of 17% have gotten better, and those are probably the ones that are at the top of the spectrum. You look at inflation, a lot of economists and policymakers are super confused because they don't understand why the average American isn't satisfied with the pace of inflation slowing year over year. Well, it's very, very simple, and actually one of the policymakers over at the Fed acknowledged this. Lisa Cook at the Fed said that Americans want prices to where they were back pre-pandemic. But of course, that will never happen. What the Fed is doing is just allowing prices to increase at a slower pace. And so if you're the average American and you're looking at your prices, your everyday prices being up some 20% over the last couple of years, well, obviously you're not going to be happy, especially now that you're starting to see gas tick up again, food tick up again. And then you got a lot of economists that say, okay, well, sure, you may feel poor, but you don't really understand that real wages are now keeping up with inflation, so you should be happy. But then you have to understand that, wait a second, real wages don't consider the dramatic increase in borrowing costs brought on by the Fed. It doesn't consider the years of lost ground where inflation far outpaced wage growth. Speaking of borrowing costs and the impacts there, you look at the impact of rate hikes on mortgages. According to data from marketplace.org, today a family needs to earn $106,000 a year to afford the median home. In 2020, it needed just $59,000. In many of the most populated cities, of course, this number is far higher. Unfortunately, for many years, Americans had felt that the decisions coming from the federal government and the Federal Reserve, well, those were not really going to have a major impact on their life. You print money, everything is fine. But unfortunately, this many years later, people are starting to realize, wait a second, but now we have 20% higher costs. All the assets are inflated. I can't buy a home. And my neighbor Susan thinks I'm a piece of shit. I don't know what that last one has to do with the government, but I'm sure they're to blame. But anyways, if you're an average American family and you struggle to even think or even dream about buying a house pre-pandemic, well, now you're not even going to dream about it anymore. You're like, shite, might as well just play the lottery now. That's about a higher chance than me getting a house. So overall, if you believe these data sets, which they're very reputable data sets, well, more than half of Americans think the economy is doing bad, and there's real reason for that. That's because most are seeing a stagnation or worsening of their family finances. Most can't afford housing. Most are frustrated with the economy in one way or the other. And in some areas, in the higher end tech jobs and some of the higher end areas of finance, people are making more money. They're doing better. But the average American is not doing better. You look at data set after data set after data set, whether you're looking at credit cards, whether you're looking at personal debt ratios, so on and so forth. Well, the average American is quite simply on the edge of survival, limping on one leg, and keeping rates high and, God forbid, raising them more will just simply push these Americans over the edge, and it's going to collapse the entire system. So that's why you're at a very, very critical point to understand that if the Fed decides to keep rates high for a very, very long time, or even decides to hike rates, well, you're going to see the whole domino game fall. There's going to be dominoes everywhere, and they're going to be falling on our heads. Of course, for us who are in the stock market, for folks who have a lot of shares in the stock market, for folks who are playing in the crypto market, whatever financial market you're playing in, well, you're making tons of money this year. And folks with the biggest amounts of capital tend to have all of their money in the markets, tend to have all their money in asset classes like real estate. And it's been a record-breaking year for the stock market, and house prices in most markets have stayed the same, and money printing has continued flowing all over into the private sector, which has largely benefited those who already had a ton of cash. But when you're talking about the average American consumer, they're not doing so good. But the folks at the very, very top of the spectrum, they're doing good, which is probably why these millionaire economists are so confused with the plight of the vast majority of Americans, and why a lot of millionaire politicians are saying Americans are misinformed about their own financial situation. inflation. Look, I'm a capitalist. I love capitalism. It's great to make tons of money in capitalism. However, when you're making that money, you can't forget about the folks that are in the middle, especially when you're making investment decisions or policy decisions, because that impacts those folks that drive the entire economy. Sadly, it does tend to be the case that politicians like to focus on the folks at the very top of the spectrum and at the very bottom of the spectrum. And look, they're important to focus on to some extent too, but you got to make sure that you understand that the engine of the economy comes from the vast majority of working people that are in the middle. And when that group gets more and more screwed, what happens? Well, the entire system starts falling apart, and all the money they pump everywhere starts resulting in massive inflation as the economy can't produce as much economic value to keep up. And they'll tell you this isn't the case. They'll tell you blah, 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 but it is the case, and country after country has learned this throughout history. And when you have a federal government and a Federal Reserve that is not in touch with the American consumer, that can cause very sloppy policy decisions that cause calamities throughout the economy. We've seen that in the past with the inflation is transitory narrative and many other crises throughout history. And it seems like we're going to see that again. But anyways, practically, what does this mean for us in the stock market? A weak American consumer will eventually force the Fed to cut rates sooner, and government will pump even more money into the economy, which will inevitably do the same thing it has always done. Push companies to make more and more money and markets to move higher and higher and the dollar to be worth less and less. When the Fed cuts rates, what do you think happens? Well, Wall Street takes that cheap money and plows it into assets, pumping the prices up higher and higher and higher. They buy up the means of production throughout the economy. They buy up all the single-family homes. They raise the rents. They screw the middle class. The middle class can't buy any of these assets. They can't afford the housing. And all of a sudden, these Wall Street guys have gutted more and more of the economy, getting richer and richer and richer. And they use that money, of course, to get the politicians in on it too. That causes the prices to go up. And of course, a lot of the middle class are just completely left out of it. And when the government spends money, where do you think that money goes? Well, infrastructure spending goes to a small number of major contractors, many of which are friends with politicians on the federal, state, or local level. When the government sends weapons to other countries, who benefits from that the most? Defense contractors that gouge the government. And quite frankly, I mean, whether you're talking housing, healthcare, banking, energy, defense, transportation, land management. The fact of the matter is that when the government sends the money, a lot of that money gets funneled through a million people and then ends up at the bottom lines of major companies in the private sector. Now, luckily for us, a lot of those are trading on the stock market, which means that we can, as investors, figure out ways to get a piece of that pie. Never, ever doubt that the big business cartel in the United States and their friends in Washington, D.C., and really at the Fed, never doubt that they're going to win again and again. Only the middle class loses in this game, and the only way to protect yourself from losing is by strategically investing in these assets so that you can take some of that power back from Wall Street, so you can take some of that power back from the big money cartel. This market will have many ups and downs. We'll have lots of new periods of big sell-offs and big uptrends, and Wall Street will try to convince you to sell everything you have during the downtrend, swear off the stock market, buy everything you have at all-time highs, rinse and repeat. They're going to take tons of money from everybody. But if you think for yourself and you understand that the money printers are controlled in DC and they're just going to print endlessly forever until the whole system falls apart, well, you can start understanding that the way to get ahead is by buying real assets, stocks, real estate, and acquiring them slowly over time and then watching as their value goes up. Understanding that uptrends and downtrends are both opportunities for you to make more moolah so that then you can go and use that moolah to acquire more assets. And right now, when you're looking at markets are testing a downtrend, but we have not yet got that 10% drop from highs, which would signal a change of trend. We're in a suspicious downtrend right now. That said, there are, of course, many individual stocks that have confirmed their downtrend. I alerted Tesla puts that have already done phenomenally well. I think there's a little bit more downside there before its eventual reversal. There's others due for very short-term downtrends like Nvidia, which already had a nice run on Friday. But right now is not the time. It is not the time to be directionally dependent. If you're somebody that needs stocks to go up or needs it to go down in the short run, in the medium run, you're going to be left holding the bag. Right now, you're in a stair step where markets drop and then try to correct upward and then drop again. And that can be a self-fulfilling prophecy really fast, where all of a sudden, if you don't get that big earnings surprise, which nobody can really guess at this point, well, you may see a lot more breaking down before an eventual V-shaped recovery. What does that sound like to you? It sounds like a lot of uncertainty back and forth, a lot of trends that change and go back and forth, which is why at this point, you can't be directionally dependent. You have to look at the current trend. You have to look at the current fundamentals behind the trend and then make a strategically placed trade with risk management. And then when you're wrong, cut losses quickly and flip to the correct trend. Right now, we're at a crucial testing ground where if you break a few more percent down, you're going to be below 2022 highs, which is when you could really start seeing legs legs start falling down and the stock market start crashing. But if earnings surprise, what could happen? Well, all of a sudden you get a rebuild and you get a big dip buy that's sooner rather than later. Right now is still a period to be increasing your hedging. On April 3rd, right before most of the downtrend, I alerted SQQQ 11 strike calls, aka shorting the NASDAQ, which was key for hedging and benefiting off the short-term pullback. And those already ran about 91%. Now, if you read over the thesis that I wrote when I alerted those, I expected the downtrend to be very, very short-lived, maybe a week or two, and these calls were really just a smart way to hedge against the downtrend that we did end up seeing a lot more aggressively this month. But with little signs of recovering, we have to assume that these SQQQ calls continue to be a solid hedge. Now, the other area I would look right now are crypto miners. Right now, I'm very bullish on crypto miners. Bitcoin tends to go up after halving, and if that trend continues, stocks like Mara and Riot and CleanSpark will have room to retrace in the coming months. Do I see more dipping over the next couple of weeks? Quite frankly, I have no idea. History suggests that usually after halving, you get a little bit of selling off in Bitcoin in the immediate week, and then overall after halving, it starts going up. And of course, the other day, we also made a video talking about the top 5 dip buys in the AI names that you want to know, and I'll put the link to that video down below as well if you want to check those out. Anyways, folks, that caps off today's video. Make sure to hit that ravishing like button and subscribe if you found value in it, and we'll see you in the next video. Make sure to take advantage of that flash 200 sale on ZipTrader options, and we'll see you in the next one.